Tonight, we're going to be talking about the wheel strategy. We're going to be talking about LEAPS and poor man covered calls. These three are some of the most popular trading strategies that are available to all of us. And the great thing is they're very easy to understand and they're very easy to execute. And they can also be very profitable. And that may be why they're so attractive for everyone to try out first and to make some money. So let's get into it. So 3 strategies with 3 jobs. So they're very related, but they also have a very unique strategy or goal with them. So with the wheel, the primary objective here is to have income generated. And the key with the wheel is you don't mind having stock ownership. So if you get assigned the shares, you're totally fine with the wheel getting assigned. And you're also very good and fine with them being called away or taken away from you. So as stock gets assigned or taken away, you're completely fine with this. And in exchange for that, you're going to get a lot of income from this. Well, we'll get into it in a little bit about exactly what the wheel is. With LEAPS, you got a very good asymmetric bet where you have very limited downside, but you have a lot of upside potential. It's one of our favorite trading strategies that we use here at CFU because it's really good to find a stock that's gone down and is finding support, and then we want to get ahead and get that upside participation. Poor man covered call is very related to its cousin, the primary trading strategy of covered call. That's where you own the shares already and you're going to sell a call on it. But with a poor man covered call, what you have now is less capital put up front, so it's more capital efficient, and you're able to still sell that covered call on top of an extended dated leap or call option that you've purchased. Okay, who's on wheel?
That would be me.
All right, buddy, let's take it away.
So generally speaking, the wheel involves using multiple forms of options and being willing to take ownership of the stock and essentially run a full cycle. The wheel analogy and graphic there. You don't necessarily need to start at any one point, like 12 o'clock on the wheel or anything like that. You can pick where you start essentially, depending on what strategy you want to use. If you start at 12 o'clock, according to this graphic here, you would be purchasing the stock up front and then selling the covered call against your position, and either be willing to have the call assigned and the shares taken away and inherently selling the stock, or having your call expire once or twice or more and buying it back to close it, and then eventually selling the stock. That would be where you're down in the lower left quadrant. And you could stay in a trade on the underlying equity by selling a cash secured put, where if you get assigned and you buy the stock at that point, you then continue the wheel. Or if your cash secured put expires worthless, then you can repeat that part of the process again and continue to drive down your cost basis when you do get assigned. So basically, it's a complete cycle involving multiple types of option trades as well as stock ownership, is how I understand it.
Thank you for that. That's exactly right, day trader. One example that we have of this is we recently did this with Retti. So what we had done here is we had sold a put credit spread up when you're around here in the mid 30s. We sold the 38 put credit spread and the 36, so the 38 over 36. What had happened is, obviously, as you can see, the stock went down very quickly. Because we had the long put with us, what we were able to do is help us to get into a really good cost basis down here in this area. So we were able to jump down and lower our cost base. I think at the beginning we were at around $26 when we took ownership of the stock. And when it started to do this pattern through here, with it oscillating and staying in a consolidation pattern through here, we're able to sell call options, I think 3 times. And then today our cost basis was $23.28. And we were able to exit the position for $24.28. And of course, our original goal was to, in essence, sell the put credit spread, or you could also see it as sell the cash secured put. But as it went down, we got assigned the stock and we could have rolled it out or unwound the assignment. But it was an opportunity for us to take ownership and begin selling covered calls against those 100 shares. And then eventually we were able to get out of that position. So that was one scenario that the wheel strategy worked really well for us. And we were able to profit on this.
I like Retti for this strategy as well because it's a high volatility typically. So you get rewarded on your options.
And so two benefits with Rigetti is that it's, right now it's down in the 23. Wow, it really did not do very well today at the close. So we got out of it when it was oscillating through this pattern here before it went down. We got out in the 24, but yeah, very high volatile name. But with it being $23 a share, to own 100 shares, you just need to have $2,300 and you're able to make some really good profit on a volatile stock, like you just said. And you could start this today by getting in and probably selling the 20 put and generate some really good. So it's trading at the 50-day average, call it. It was there today, and the 200-day moving average is coming up below it here. So it very likely is going to have some consolidation through here as it tries to have the two averages come together and buyers and sellers argue over what is the worth of Rigetti.
Nifty is acting as some pretty serious resistance right there.
Yeah, exactly, right? So it's got serious resistance through here, and then below it, it's also got really good support. The strategy was a put credit spread to begin with, but we were able to enter into and roll a number of times covered calls into it. But after it's been acting like this, one of the strategies you might look into is just doing an iron condor on it. It might be one to go with for a bit.
Setting a range.
Yeah, exactly. Which an iron condor, for those that are watching or listening and don't know what that is, it's a option strategy where you're trying to say that, or you benefit from a neutral or sideways price action into the expiry there. But I mean, yeah, we could easily roll in and do like a cash secured put or another put credit spread below this and wait for it to come into our price range that we're willing to buy. And then we could go again with covered calls. So this is the wheel strategy, very good income generator, and you can make a lot of profit on this. The key with the wheel strategy is you have to be willing to take ownership of the stock.
As you said at the beginning, there's no rule about where you have to enter the wheel. So your general rules of collecting max premium apply. A stock that's heading down, a very logical place to start with that would be selling your put credit spread. If the stock is shooting up and up and up, just buy the stock and sell the call. You'll make a lot more money. You have a stock that's going up and up, something like NVIDIA the last number of months, you will just stay stuck at phase one of that wheel. So that you can choose where to enter.
Do you have like my favorite way to enter is with the cash secured.
Yeah,
there's a stock
I like
that.
And you can get more aggressive on that put than you would knowing you're going to wheel. But you want to, a classic rule, stocks going up, you're going to get your better premium selling calls. Stocks going down, you're going to get better premium selling your puts.
That's right. Yes. We did this last year as well, too, with Berkshire Hathaway selling cash secured puts on BRKB. And then when we got assigned, we sold a lot of covered calls on that. In fact, we had a long streak where I think it was 4 or 5 months in a row we sold the cash secured put. So we never got assigned.
I think that was a very nice run.
So I think we've kind of gone over this feature or failure. This is kind of a funny question. Do you think getting assigned through the wheel, getting assigned or put shares to you or having your shares called away, do you think that's a feature of the wheel strategy or more of a failure of it not working correctly?
Absolute feature.
Yeah. I would agree completely. It's the intent, essentially, at some point, right?
Exactly. I don't think you'd ever want to avoid assignment altogether, because if you're avoiding assignment all the time with the wheel, you're likely not taking on enough risk and you're not getting enough reward. You're just kind of passively getting like $10 or $20 every month when you should be getting a whole lot more. So pick stocks that you're willing to buy or that you're interested in.
Yeah. Wheels work best with quality stocks. Right now, I'm beginning my personal wheeling GLD. With the current rise, you can do it now.
Yeah, you might as well.
Typically, there wouldn't be enough money in that premium-wise, but the last 6 months, we now have options premiums for gold. Never thought I'd live long enough to see that happen, but here we are.
There was a Virginia dog in our Discord. He has been selling put credit spreads on GLD or gold all year long last year. And he was just making a mint off. He's like, man, this thing is I just keep on fleecing this thing for money on it.
Yeah.
Yeah. It's crazy how metals have been going. And then silver today getting over 101. Did you ever think you'd ever say that?
I never thought I'd see that personally.
Right. $101 for 1 troy ounce of silver. I put a tweet out today where I'm like, what? So you got $101. Do you want 1 troy ounce of silver or do you want 69 hot dogs from Costco? Because it's the same price.
Right. Yeah.
Yeah. Okay, let's move on. Let's go to LEAPS. This is one of the fun and exciting ones. The category of LEAPS is asymmetric bet, limited downside or a defined downside and a lot of upside. It's unlimited. It can run. Speaking of running, Will, do you want to take this for us?
Sure. So LEAP is you're buying a long dated call. That is the fancy way of describing a LEAP. When you buy a call, you pay your premium up front. You own that call. What you've paid is your maximum loss if you hold it to the absolute end. That is generally not the goal.
It's technically
a year, so you get a year. Sometimes in the channel, we have our expert on LEAPS, Kyle. It'll be 10, 11 months, but it'll still be called a LEAP.
Yeah.
But the principle's the same. It's out quite a bit in the future, generally at the money, and with a stock that's of reasonable quality that's expected to rise. The LEAP isn't hedged by anything, so you have unlimited depreciation, and your loss is limited to the premium that you've paid.
all right. So
And-
you made a killing this last little while, right?
Yes,
And
yes.
I think I know which stock we're going to talk about.
Novo Nordisk.
All right. Do you know? So their drug that they had come out, I forget what it was called, Rebellicis or something. It's their Regroovy drug, but it's the oral form.
Yes.
Okay. So step us through this.
All right. I'm going to have to squint. I'm on the small laptop monitor here.
You're
so-
always on that small laptop. We got to get you
Well-
one of those
Well, not
monitors.
well, I have my 36-inch widescreen at my desk, but I've been on the road a couple weeks.
I know. I gotcha.
All right. So effectively, when the stock dropped, we put out a trade alert that says, pick up this call it's generally at the money, and it's roughly a year into the future. And when that call is purchased, team continues to watch it. And when the stock appreciates quite quickly, the value of that long dated call increases, and it can increase by about 10 or 20% in a matter of days. And that's in a perfect world. The goal with buying a LEAP is not that you hold it to expiry or generally not even much longer than the next earnings period. So what happened with Novo Nordisk, it's just been, I haven't been following the news. Novo Nordisk is not one I follow. I followed the team on this one, but during the dips, we purchased the call, and when it spiked, we sold.
Yeah. So with the story with Novo is they're in the weight loss drug space, let's call it. They're competing against Eli Lilly. And during this downtrend here, this is when they were having Regroovy come out. They were a nice competitor to Ozempic, and they were nice and cheap, just a little bit cheaper. Then that's when they kind of peaked here because Eli Lilly came out with their drug called Zepbound, I believe it's called. And Zepbound is more powerful. It's better than Regroovy. It's better than Ozempic. And they're going to eat the market share through here. And so that's why Novo was having a real difficult time through this and why they were getting sold off, because Eli Lilly, on the other hand, was doing fantastic. They almost have the inverse chart of this. Novo was suffering. But then Novo came out with this new drug that was oral form. So all of these drugs is GLP-1 drugs. You have to inject them. They came out with an oral tablet. You just take it once a day, and it's cheaper, much cheaper than the injectable pins. So through here, it was seeing some discovery, hey, this is going to get really good. And then they got FDA approval, and that's when the formation of the bottom came in. And then now what they're seeing is they are having a really good ride up here because the drug is actually having success. It's being taken off the shelf, and I think Amazon's even agreed to help them ship it and distribute it. So when we started buying the LEAPS on this was around here on the bottom. This is when we had our first trade alert go through to buy the January 55 call option on it. And nothing really happened until it took off here when it got the FDA approval. And then we sold that LEAP, and then we bought the LEAP again right around here, sold it when it rose, and then we bought it again here, and we just sold it again. So we got 3 in a row off of Novo Nordisk and made a killing off of it. Each time we were buying the January 2027 call. So like 12 months out into the future, but we bought and sold it. I don't think we even went over. I think the longest one was the first one, and that went like a week or two. I think it was 9 days. And then through here, it was like 1 or 2 days, maybe 3. And this last one was just 1 day. And so, although we're buying a really long dated option, we have no intention of holding it for anywhere near that. Ideally, we want out within a month, and we nailed it every single time with Novo Nordisk this last month.
Want to give an example of some of the premium that you were
Yeah.
paying for the call versus the outright 100 share purchase?
Yeah, really good point, day trader. So roughly we were spending about 1,100 to 1,400 each time we bought this. So instead of buying the shares at 46 a share, so that would be $4,600, we were only paying $1,400 for the right to buy those shares, or sometimes even $1,100. So that's the appeal of it, is we put down $1,100, $1,300, $1,400 to control $5,500 worth of stock, and we get almost 1-for-1 price appreciation. So for every dollar that the stock went up, we got like 75 cents of each one of those dollars going up. And so there's a lot of leverage, and yeah, you do need to be careful. You are trading a derivative instrument, but the leverage is amazing. And so you get like almost dollar for dollar stock appreciation for like 1/3 of the cost. And there's no borrowing cost. It's just you pay for the price. That's the most you can lose. And then when you get out, so we would get out, we would buy it for $1,100, and we'd get out for like $1,450. And so we got the $350 worth of profit on that. And we never even held the stock. So does that answer your question? I know you were just trying to remind me to say that. So I think I got it.
Yeah, absolutely. Right. That was good.
Yeah.
That was great. Yeah, thanks.
Yeah. Do you trade leaps on anything else?
Not typically. Area of strength. Kyle, by way of background, is one of our pro traders. He has 2 channels in the Discord. Kyle has a truly extraordinary gift with leaps. So I don't devote any time looking at it, because even if I spent days and days studying, I would not hit his record or his expertise. So I trust the expert. Anyone that's here can scroll back on you can see on the website Kyle's history with the leaps. It's fairly easy to ascertain, and my comment will make a lot more sense when you see the history in front of you.
So with CFU, this is our Discord here. I've just logged into it. And here is Kyle here. And this is our master trader. He's so good at calling these leaps. I just scroll through there real quick. And he also has this other channel called Kyle 10K Trades. And through here, he has some other trades that are geared for $10,000 or below accounts. And so he'll take it a little bit easier through here. So for example, he wants to buy some shares in NCNO at just $23 per share. So he just bought 50 of those. But in his master channel here, this is where he's selling some really good leaps and other strategies. So here, when he was trading off and closing off Novo Nordisk here, so we got that filled at 14.30. I was a day late actually on the fill on this, and so I got mine filled this morning for like 15.30. So I actually got an extra $100 on that. But the official count is we'll go with what he did for the performance there. So this is, so if you're new to CFU, these are our trader channels through here. We got Kyle trading, Uzi trading, Lee trading, some members such as yourself. Well, you'll drop a trade or two in here as well. So that's great. And then down here below, we have our system trades, or the channels that I run. And they're a great way to get started. Very risk controlled and hedged, fully hedged the whole time. A great area for people to get started with. Okay. I did want to cover Netflix. So this is one I've been eyeing. So they did not do very well recently on their earnings report. They beat on the top and the bottom, but they've got some bad guidance going forward, and they're just not getting any love from Wall Street. I don't know if it's like the Squid Game favor is over and they got to get something new, or maybe it's Hollywood acting up with them and saying, man, like, this Warner Brothers thing. But they're back now to where they were trading a year ago. So if we go back, this is April 2025, this is March, and back through here should be January. Yeah, so almost to the day, right? January 21, it was trading at this exact same level. Imagine you own the stock for a year and it hasn't gone anywhere. Man, that's depressing. I say that tongue in cheek because, like, you remember Microsoft through the 2000s? It didn't go anywhere for 10 years.
And I got to give a brief segue because it's become a bit of a meme again to dump on poor Steve Ballmer. And it's true, the price didn't move for a decade during his tenure as CEO, but he started at the dot-com burst and ended around the financial crisis. So it was a rough run he had.
Yeah.
But I do
History.
remember that decade. And Berkshire didn't do much for about 4 or 5 years in the middle there as well. So you can have desert on quality stocks.
That's true. Okay, so with Netflix here, I'm looking at trying to get the 85 leap on this one. So if we go, let's look at the one for a second so we can price it out. Come over here.
Now you're in optionstrat.com here, right?
That's right. Yeah. So this is optionstrat.com. This is a free service. Anyone can come to this website. It's fantastic for pricing out options, building strategies. You can see here when I go to the optimized Netflix, I tell it that I'm bullish and it comes up with some suggested strategies already. So you can go long call, covered call, cash secured put, all these different strategies. And all of these we incorporate and use at CFU. So the bull put spread, the bull call spread, short put or cash secured put, long call or the LEAP, covered call, the PMCC, cash secured. So let's go into the LEAP. So this is January 30th of this year. So we got to go a year out. So we're looking at January 2027. I guess you could do December if you wanted to, but let's just keep it to the textbook. And then let's say we want to do Delta 65. That's kind of the sweet spot for a LEAP. So that's another tip too. When you're buying these LEAPs, you want to get at least Delta 65. That means that for every dollar that the stock goes up, so for every dollar that Netflix goes from 86 to 87 to 88, you're going to get 66 cents of appreciation, or $66. And so you're only going to pay $1,600 for this, or $1,620 to control $8,600 worth of stock. So it's a nice bit of leverage there. And you're going to get some good price appreciation on Netflix as it goes. So, I mean, there's no reason why Netflix couldn't be trading at $100 very easily. And it could actually happen pretty quick here. So that's something that I've been eyeing. I haven't entered the trade, but I could do so here in the short term. Okay, let's move on. Let's go to the PMCC. Poor man's covered call. So this is capital efficient with less risk. So for example, if I wanted to do a covered call on Netflix, let's just pull that one up here with Option Strat. Let's go out to March 20th. I think it would be probably one you'd be interested in doing. And you'd probably want to sell, we can maybe go up to 95. Yeah, so you can sell the 95 call. What I'm looking at here is Delta 25. So when I'm selling a covered call, I want to be selling Delta 25 to Delta 35. It's kind of the sweet spot. Anything less than that, so say I did like the 100 call option on this, Delta 14 or Delta 15, you're just not getting enough premium. You're only going to get $80. Like that's not very much for putting on a risk of $8,600. And if you went too tight and got Delta 50, Delta 55 is at the money, you're going to get paid real nice, but you've got a really high chance of getting those shares called away because you're already in the money by 9 cents. But it is more defensive, so you do get more downside protection. The 95 call option is a real nice one. You're going to get $150. You got $10 of appreciation before you even have to think about delivering the shares at that. And you still get some downside, not too much, but some. And, you'd be good to hold the shares even if it went all the way down to $80, right? So the poor man's covered call is kind of what it sounds like. Is there some way that I could construct a covered call without putting up $8,600? There is. It's called the poor man covered call. So instead of buying the stock, what you would do is you would buy something similar to a LEAP to go with it. So you would buy a longer dated call option that's definitely below your short call or your covered call, and you're making sure that it's got enough kind of intrinsic value already. So let's build that one out. If I was here and I wanted to sell, it's going to be like this. There's no default way to build a poor man covered call with Option Strat, but what you can do is you can start with a bull call spread. So I'm going to buy the 80 call and I'm going to sell that 95. This is for the same expiry date, right? That's a bull or a debit spread or a bull call spread, exact same thing. And you would do this for $680. But what I want to do is I want to change the expiration on this. So what I want to do is I'm going to sell the March 20th, and actually, maybe what I'll do is I'll sell the near dated. Yeah, I'll make this more closer to my expiry. So let's go February 6th here. So this is 2 weeks out from today. Need more delta. And so that would be a 30 delta. So that's nice and good. And we're going to get paid $125, $130 for this. And so what we have to do though, in order to cover this and make sure that we're hedged, we would buy the March 20th. And so we would put down $840, let's say, because that's the midpoint between the bid and the ask. And then we're also going to sell the near dated term call option for $130. That helps us to decrease the overall cost that we have to put out. And so for $700, we're able to enter this position, and we basically created a covered call. And if you look at the graph here, it's very similar to what a covered call would have for a profit and loss. The benefit of this is, say this February 6th option expires worthless, we still hold this March 20th 80 call option. We can continue to sell the Feb 13 or Feb 20 and continue to lower our cost basis, or in other words, continue to generate income against that.
Fantastic. Since you're selling a call against a call you already own, that can be used in conjunction with the LEAP strategy.
With that Novo play that you had out there, you could have been selling covered calls on top of that. Now that you're into some profit on the LEAP, you could have started selling some covered calls against it, near dated, and generate some income off of that too. That's really true.
Precisely.
Yep.
Now, let's say you enter into a LEAP trade. Would there be a situation where you want to turn it into a poor man call, cover call?
Yeah, and I think that's kind of the scenario that we were just talking about with Novo, is that you had this long dated January 2027 55 call option. It's definitely in the money now. Nice little run up on Novo. So you could start selling some short dated covered calls on top of that to generate some income. You definitely could. Yeah, that's definitely a strategy. So that would be something to do for somebody who's more interested in generating income. I think the guys, like when you're entering to a LEAP and you're entering in with the goal of, I want to get price appreciation, I'm looking for stocks that are bottoming out, like we were doing with that Netflix one here. But you could definitely do that if that's your goal. Yeah. Have you ever like switched strategies and said, no, I'm not interested in it, I want to flip and go do something different?
Not personally, but we've done this before on some of our longer rolls that we've had to work heavy with.
That is true. So when we're rolling some of the positions that we've entered into, sometimes after we've done a few of the rolls and it's looking like we're kind of bottoming out on that stock, it's time to enter into a poor man covered call. We've done that with Target. We did that recently where the January 90 call option on Target. And what we've done is we've sold the March call option at the 115 strike. This is Target here. We entered into a lot of rolls on this. This is one of our longer duration trades that we've been doing. And when it got down into here, we were trying to get it up and out of here. So we were doing some debit call spreads and some more put credit spreads on this, but we just didn't get the price appreciation that we needed. So what we did is we bought the 90 call option for January of next year. And then when it did this nice run up here, what we've done, and actually we nailed this in terms of selling the right time, we sold the 115 covered call on Target to lower our cost base on that 90 call option by a significant amount. And now we're in a really good spot. If Target can then go above 115 by March of this year, then we're going to be looking real nice. Oh, here it is. I can show that. So that was in our CFU Black, and we sold the Target.
Our timing was almost surgical on that, as I recall.
Yeah, it was really bang on. Here, just let me search for it off screen. In Target. Yeah, here it is. Yeah, so we sold that on January 8th of this year. Yeah, so Target rose up to 106. We have the January 90 call. Let's reduce the cost basis further. So we sold that for 415. And so our cost basis entering into that trade was 28.44 down. And then we lowered that down to under $25. And so if Target can get to 115, then we can sell that entire position for $30 or more, which would generate a lot of profit for us. And we'd be able to exit the Target trade finally and get that all done. And this kind of a trade is something that we just want to do with members that have already been in it. You don't want to enter this if you're brand new or not already in the position here. And this was the chart that we had at the time. So we were calling it, this would be at the top at the time. And we got a really good credit on that. And then, oh, here's Bitcoin, not the one we're looking for. There it is.
Yeah.
So looking really good. So this is one of those examples where we converted into. So one of the things you want to be careful with the poor man's covered call is delta flip or delta inversion. So this might sound like a brand new thing, or they maybe haven't heard about this, but it's one of the unique risks that come with a poor man's covered call that you don't really have with a covered call. So let's just cover that real quick so everyone's on the same page. So when you sell that call option, going back in here onto option strat, or was it when I had yeah, here. So on this one here, so what happens is if this is the optimal price, so if Netflix can be priced at $88, essentially your strike price here on March, if it can be at that point, that is your optimal time to exit the trade. So at this point, this 88 call option for March will expire worthless, and your 80 call option that you have for, sorry, the shorted, sorry, this is February 20th. So the 88 call option expires worthless or just barely in the money, and you can sell this March option for the most price appreciation that you had. What happens is as you go above this line, so as you start to spike up here, you will start to lose money and you won't get as much profit. So you can see here, the profit here is $255. And out here, what's happening is you're starting to lose that optimal profit. This doesn't happen with a covered call. It becomes a very straight line, right? As we all know. Why this is happening is the price appreciation of the short call, the 88 call that you sold for February 2nd, it is starting to appreciate faster than the underlying long call option that you have at 80. That's because the delta on your 88 is higher than your 80 call option for March. And so that short option is running away faster than your long option can catch up. This gets more profound the lower you get and the closer delta starts off with to begin with. Okay. So if you bought that 80 call option for March and you're like, I want to play this conservative, I'm a poor man covered call. And so you sold the 83 call option for February 20th, $83 is your optimal price, but see how it starts to run away on you as it goes up in price. And then you can actually start to lose money because that 83 call option is much more valuable than the 80 call option out back here. It has got gamma and it's got delta and likely some volatility running with it. And this is so long. It's like this old long legged dog that's just not catching up quick enough. So that's what's happening through here is delta inversion. The short option is running away faster than your long option. So it's one of the unique risks that come with poor call that you don't get with a covered call. So just keep that in mind if you're interested in poor man covered call. It's a unique risk to it. Make sure you're staying well out of the money or well above your short strike. Okay? And that's a good risk to be aware of because you might be very tempted to do this one, but you don't have that same risk of inversion. And then if you get into this pickle, you'd say it's a devil to get out of this one. So you can start to chip away, roll it up, but it takes a lot longer and you get very close to this March date. Okay, so that's inversion. Good risk to know about. Okay, so this is the strategy comparison. So wheel, you get high capital. So remember, you got to come into this like, yeah, I'm okay to take some ownership of the stock. It's very easy to do. You're selling covered calls or you're selling cash secured puts. And this is really good for just, hey, I have some cash. I just want to generate some income and I'm okay with ownership. With LEAPS, you have the capital requirement is much lower than owning stock, but it's much higher than if you were just going to do a shorter dated call option. The complexity, I would actually even argue this is even less complicated than the wheel strategy because you're just buying a long call and you're hoping it goes up in price. When it goes up in price, you sell that long call for your profit. I don't know if I'd even agree with that too, because like we've been trading Novo Nordisk all month 3 times and we've still been whipping the January 2027 call option. So I don't think you have to stay in it for very long. Once you got your profit, good time to get out. Poor man covered call capital is lower of all 3 of these. And because you saw in our previous example with Netflix, we were able to get in there at like $700 or so to construct that poor man covered call, whereas the LEAP needed something like $1,600 if I remember correctly. And then if you're wheeling Netflix, now you're into the $8,600 range. Complexity can be a little high. So that's kind of the risk with poor man covered call. Everyone enters into it thinking it's low risk. It's just the same as a covered call. That might be the glossy brochure paper on it, but it does have some unique risks that you just need to be aware of. and that has to do with delta inversion. And it's best for, you're just interested in doing income off of this. You're interested in selling shorter dated covered calls on that longer dated long call option. And your goal is probably to do that 2 or 3 times. I don't think you'd want to do it on a short term, hey, let's just get one and done. You want to get into it a couple times there and sell a few covered calls on it. What do you think, Will?
I think we've got it. I think that's a great outline of 3 strategies.
There was one comment from YouTube. That I saw.
Yeah, here we go. Please talk about the process of selecting stocks fundamentals and right entry technicals and management when stock goes south. That's a really good question. A 3-pointer on that one. Selecting the stocks and fundamentals. I guess I can only really speak to it from my own personal experience and my own personal convictions. I'm very oriented towards high conviction stock plays that I want to invest into. I always think about what is going to be in demand 5 years from now and 10 years from now. For example, take Amazon. They produce products and they deliver a service. Are there products and is their service going to be in more demand, equal demand, or less demand in the future? I would argue it's at least going to be the same because they've got such saturation of their market, or it's even going to be even higher. And that's going to hurt retail. So I would avoid retail stocks and I would embrace Amazon or other companies such as Shopify. So that's how I pick it. I like to think about what's in 10 years and how can I align to that? And then I would go along the lines of I favor growth over value and dividends. You won't hear me talk much about dividends, but that doesn't mean dividends is wrong. That's a different investing approach. So another thesis that I have right now is I think that robotics and autonomous driving is going to be 2 themes that are going to dominate 2030 and 2035. So what are the companies that are going to get me towards that? Who's going to be a player with autonomous driving? I think autonomous driving is a high conviction play because that can come into logistics with semi trucks and delivering the final mile. It can come into like Uber and Lyft. It can also help the younger generations that don't want to own cars because it's just easier to jump into a cab and have them go. They love Uber, but I think Uber is up for destruction here. I think the autonomous driving by Waymo and Tesla are going to make it very difficult for them. From a fundamental standpoint, that's how I like to pick my stocks. So top of the heap for me, yes, Tesla. Another one on top of the heat for me is NVIDIA. I think NVIDIA is playing a really good game. They have the dominant chip for AI. Nobody can do it better than them. And they also have the CUDA moat that nobody can, like once you're into and you're in bed with NVIDIA, it's very difficult to get out. I think Google is going to be another player in the space. And they're also a stock that I do have a position in Google, but I do have more in NVIDIA. My 2 top plays are Tesla and NVIDIA. Now, don't talk to me about Bitcoin because I can fill your ear for hours on that. I'll save that for a different topic because that's not a stock. The right entry and technicals. So I do pay a lot of attention to 50-day moving average and the 200-day moving average. You can see that in my charts that I have. I'll bring this up again. This is just target. So let's just talk about target. So like down here, right, where it's showing support, this is a good entry point here. This is a strong low that has been formed off this. If you're wondering what my indicators are and my setup for TradingView, look for smart money concepts. There's a lot of filters and indicators for smart money concepts. You can just go on here and go on indicators and you can add in smart money concepts. It's a Lux Algo. They do have a paid subscription. I'm not going to promote it on here. I do use them as a paid subscription, but they do have a few free features as well too, such as smart money concepts. That will put on things like this where it's going to talk to you about the premium and the low and the resistance here. So these are really good spots here. So target, with it being at a premium, this is where I'd be selling. If I don't want to sell the stock, I could sell a covered call at this point. And then equilibrium, this is where it's saying this is the fair value for it. These lines in here are fair value gaps. This is where the market was willing to pay the asking price. Okay, so these lines through here are fair value gaps. This means that whoever's buying in here is very motivated to buy, and they're continually slapping the ask, which is a market term for continually say, nope, just keep on buying, keep on buying. They're putting in market orders, and the market maker's having to fill them. This is it running up. So this is a really good indicator that whoever's buying target really sees a lot of upside, and that's going to continue for a while. So that's what I use for indicators to know if it's a time to buy or sell, and where they would be. Down here below are the momentum indicators. Target has been bullish for a very long time and is likely exhausting out. So this should continue to oscillate downwards. And through here is where it should start to turn around. Now, it's not guaranteed. Nothing is guaranteed in the markets, but it should continue to lose bullish momentum here. If it regains it, that's a whole different game. And management when stock goes south. Okay, so that's kind of my bread and butter. I'm a rollaholic, as I like to frame it. I love to roll. So I have no problem rolling and rolling and rolling a stock until it gets into the profit zone and I can exit that for profit. Now, that doesn't mean a lot of other traders, such as Kyle, that we've already talked about here today, he doesn't like to roll. So he'll take the loss and move on. That's totally fine, assuming that his next trade, which likely is going to be profitable, which could then make up for that loss that he had in the previous trade. Me, myself, the way that I trade, I've learned, and I don't know why, but it really helps me to know that I can turn almost any trade into a profitable trade. We're at trade 868, I think, right now in CFU, and about half of those are mine, and almost 95% of those, in fact, I think it's higher than 95%, have been profitable because I'm able to roll, stay in the trade, learn from the trade, learn how it's trading, the price action that we're getting, and then using my mechanism of rolling, I can get it to go into profit. So I think I've addressed all three of your points that you had there. It's a really good question, and it's difficult to unpack and answer them one by one, but I think I did somewhat of a good job. Hopefully that answered a lot of your questions. If you have additional questions, just drop it in the chat there, and I'll give Will and Day Trader an opportunity to weigh in on that. I'm actually curious on your insights and how you play this.
Okay, I'll go first here. Starting with fundamentals, I would suggest that you understand the theme of the equity that you're looking at and that you understand the time frame that you're looking for your trade, but also the time frame that the sector is going to be strong or weak, whichever side you're playing to first. And then if fundamentally is the company profitable, all of those factors. And then from a technical standpoint, I look at moving average crossovers on different time frames, like Stephen mentioned. In this case, he's got
Right
the
here.
50 and the 200. And so when I see this with target, that break over the 50 is bullish, and with the 50 crossing over the 200 later, that's bullish as well. But you can see that you're up against resistance above, so there could be a pullback, but generally speaking, as long as that trend continues, it could continue bullish. So with different points on the wheels, different technicals come into play. If I'm long already and I'm looking to sell a covered call, I tend to look at RSI, maybe the Bollingers, and look to see if I'm overbought, considering selling a covered call into a pullback, and then continuing to maintain the position while chipping away at my cost basis. And then if I'm looking at selling a cash secured put, then what I'm looking for there would be to expect that the price will stay above the put that I sell so that I can continue to sell puts against it possibly. But understanding where you are on the chart, technically speaking, is important, and whatever indicator combination works best for you in terms of understanding where you are in the cycle is important. And then from a management standpoint, this is where I've really benefited in CFU because I didn't have much complex option exposure before joining a few years ago. And my first few times I got really anxious and nervous with assignments and things like that. But watching Stephen over the years has taught me to embrace it to a certain extent, but obviously manage my margin, but know that if I jump in a trade, it pays to stay with the trade as long as I can because Stephen finds a way to pull him through. So I just wanted to
Thanks,
put that
Day
out there.
Trader. I appreciate that. It's one of the hallmarks of Think is we bring a level of just like calmness to trading the market. We are trading a derivative instrument, and by definition, a derivative is always going to be more risky than the underlying asset by its very nature of being derived value from the underlying, especially when we're going to trade something like Bitcoin or strategy or NVIDIA. They inherently have more volatility because the market's trying to explore and find just what is Palantir worth. But with our mechanism and the way that we can trade Palantir and do it in a calm, collected, confident manner because we know that, yes, we have done our homework and we think that a particular trade on Palantir is going to go to our favor. But if it doesn't, because sometimes, nobody knows what the future holds and nobody has a crystal ball. So when it goes against us, we know how to handle it. So we're very good at risk management. And it's one of the hallmarks that we have. So you can trade, you can sleep at night. I sleep at night just fine, knowing that we have a community of 1,000 members and we're trading with them. We're helping them get better at option trading and learning the mechanics of how these all work. And we can share how we do a roll. We can share how we enter and exit a trade. What are the limit orders that we put in order to jump in? A lot of members are, when they first start, they're a little surprised that we have particular limit orders. We never, ever do a market order when we're trying to fill an option trade. That's a top tip right there. And very simple. Don't do market orders when you're doing options. Always use limit orders. Because you can put the limit order right between the bid and the ask, and the market will likely fill it. That gives you an extra $10 to $15 on most liquid stocks. Even you can do that with Tesla. And when we're using all of our hedging strategies, it's very important to use limit orders because you're trying to find a limit order that's precisely down the middle because you're using two legs within that option trade. So always use limit orders. That'll make you a better option trader. And then, we know how to roll. We know how we need to exit. Like, for example, Broadcom. We exited Broadcom. It didn't go our way. We're bullish on Broadcom. I'm bullish on Broadcom. But today, it did not have a good day. It pulled back, likely to fall in sympathy with Intel because Intel has supply problems. But we know how to handle it. We know Broadcom long-term is a good, solid stock. So waking up this morning, a lot of people would have had anxiety or apprehension about Broadcom. What's going to happen? What are we going to do? Sell the put that we already have in place against Broadcom so we can sell it for $340 per share. Now, this is the next leg of that roll. We're going to go in and we're going to sell the 280 call and we're going to buy the 275 call to further reduce our cost basis and reinforce that hedge. So that's a big lesson that most members learn from CFU is how to confidently trade, stay calm. There's no need to overreact. The market's open all day long. We have 8 hours to fill our trades. And so that's a lot of value that we bring to trading this market. Thanks, day trader. Okay, so let's wrap up. We've been going for over an hour. Okay, so this is our comparison. The right strategy depends on you. So depending on your sentiment, your goals, and what you want to do with your option trading, you might want to do more wheeling. It's a very popular strategy to begin with, very easy to understand. The only downside is a little more capital intensive, and you do need to be willing to own the stock. Poor man covered call is another strategy, low capital. Your primary goal here is to generate some income. LEAPS, it's more of a bet and more of a long-term horizon that you have, and you're being more aggressive with the stock. However, it's a fantastic upside. LEAPS are the prototypical asymmetric bet. Limited downside, a lot of upside. Okay, so just finishing up here, if you're interested in learning more about options and trading with CFU, we have an option income starter kit. This is 3 things that we offer you for free. You can get our free ebook. It's the option income blueprint. We also offer you our free trade scanner. So if you're interested in learning how to trade put credit spreads, which are a fantastic tool to use, we have an option trader scanner for put credit spreads. It's free to use. And we scan 30 stocks every single minute of every market, and we find the optimal put credit spread to trade. And we're talking about the best stocks: Broadcom, Micron, NVIDIA, Palantir, HIMS, Tesla, the list goes on. There's 30. We picked the top ones. Yes, we have Apple. We also have the Discord community, so you can join for free. You can jump in and you can participate for free in CFU. Yes, it's limited access because we reserve the best trade alerts and the best community participation for our paying members. But if you're interested in just checking it out, see how Discord community even works to begin with, you can join for free. You can see some of the market news that we're sharing. And once in a while, we'll drop a free trade down there. And it's great. You can grab that free trade, try it out, see how it goes, and we'll fully support that trade for you. So if it goes sideways, you can see how we manage risk, which is very important. So if you want to check it out, the link is in the description. And you can go to joincfu.com, and that's a fantastic website there where you can check out CFU and see everything that we have to offer there.